Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So just last night I put up a community post asking for questions for a Q&A video, and this is the Q&A video. So thank you to everyone who asked a question. If you do want to ask questions for future videos, basically just turn on your notifications for the channel. I pretty much always ask for questions on my community page on YouTube, so keep an eye out for what I post there, and that way you can get your questions answered in future videos. But for now, let's get straight into the video. Okay, and we do have quite a few questions, so if you did ask one and I don't get to it, I apologize in advance for not being able to get through them all, but we do have quite a few questions. I'll do my best to get through everything we've got here, but just a heads up, apologies if I don't make it. So, first question is from Michael Slade. Are you finding any opportunities in this current market using Phil Town's 15%, I think that means minimum rate of return, 15% minimum rate of return, and 50% margin of safety means all the stocks on my watch list are insanely overpriced. I recently transitioned to value investing mindset from more of a dividend background starting out, but at the moment there's such a big discrepancy between my buy prices for stocks I like and their current price, it feels like they'll never drop enough. Yeah, so this is an interesting one, and this is one that, I think probably a lot of people are finding at the moment. If you listen to Phil Town himself, he's got a huge percentage of his portfolio in cash. I did a video not too long ago sort of going through that as well. He's got like 30+% of his portfolio in cash. So, I think a couple of things here. So firstly, I think you need to understand that really good investment opportunities are rare. This formula from Phil Town looking for 15% a year plus a 50% margin of safety, if you're right on all of those things, you're going to be compounding money at well into the 20% a year range. And to be able to find, investments that tick those boxes is a really difficult thing to do. It's not going to come up every week or every month, or you might not even find one every year. So I think you have to understand that, investment opportunities that fit this sort of criteria are rare. The second thing I would say is that a lot of companies that have been on my watch list for a long period of time also fall into this category of basically very rarely ever hitting my buy price. And I think that's because a lot of those companies that, especially in the early days that went on my watch list, were very large, very well-known businesses. And it's going to take something fairly dramatic for, a business like Apple or Microsoft or Costco or Monster Beverage or some of these really well-known, easy to understand kind of businesses. It's going to take a lot for them to get to a big margin of safety price. They're so heavily followed. There's a lot of people that would love to own those businesses. Some people would love to own those businesses just about at any price. And, some people that are more strict like us will tend to load up the truck as soon as they get to some sort of, more reasonable valuation. So to answer your question is, it is more difficult than it might have been a few years ago. If it was 2008 or 2009, you'd be able to throw a dart and find something at a 50% margin of safety. Right now, it is the opposite. But the other thing I would say is you should, be open to hunting outside of really large, really well-known companies. It's unlikely that Apple, for example, is going to get mispriced, here in 2021. So if you can get past, the S&P 500 type stocks or even the top 50 stocks in the S&P 500, that is generally a much more productive hunting ground. You're going to find less closely followed companies, and there's going to be a larger chance that you can find, that big 50% margin of safety. Next question is from Joshua. Where do you get information on companies to invest in, and how do you decide that you want to look into a company? Is it just general interest? What sort of things do you look out for when deciding whether you want to buy? Sure. So I guess in terms of whether I look into a company or not, there's basically two initial criteria that I probably use just to discard stocks very quickly and kind of move on to the next thing. That's something I actually learned from Monish Pabrias. He sort of sees his job not as trying to find stocks to invest in, but rather finding reasons not to invest in stocks. And if you just continually dig into businesses and you find a couple of companies where you just cannot find a reason why you wouldn't invest in this company, that's kind of the process that he sort of follows. So I tend to do that as well and try and discard companies as quickly as possible. So I guess the first two initial things would be, number one, is it in my circle of competence? So making sure that it's in an industry that I either understand currently or I think I have the ability to get my head around relatively simply. And the second thing is some basic, financials and sort of valuation metrics. So for example, if I look up a business just on my phone right now, like Snowflake, I've just pulled up, and then I'm just looking on Yahoo Finance. Maybe I'll actually record my screen here right now, and then you can see what I'm actually looking at. Cool, so I've just pulled Snowflake up on my phone. If I go on Yahoo Finance across to statistics and say view all, I'm going to see some basic sort of metrics on how this company is valued. And one of the things that's going to jump off the page to me for Snowflake is they have a price to sales ratio of close to 90. They have a price to book value of something ridiculous, 14. They have no forward PE, no trailing PE. So these are all things that are kind of red flags for me as someone looking to, buy good businesses at attractive prices. This isn't to say that Snowflake won't do well. It's just to say that in order for them to get down to a reasonable valuation, they're going to have to achieve dramatic growth out into the future. So that's kind of a first initial thing. I'd probably also look at maybe some of the history of the growth of that particular business. So again, if I look at Snowflake, I will again record my screen here because I just stopped it. If I look at Snowflake again here, I'm going to see annual revenue and earnings numbers for the business. I'm just under the details tab on the Yahoo Finance app. And each year I can go through and see revenue and earnings. And for Snowflake, revenue is growing very fast. Earnings are negative every single year, and they're getting actually more negative as years go by. So those are kind of a couple of initial screens. If the financials look really good and it's in my circle of competence and just some initial real basic ratios, look reasonable, like a PE or a EV/EBIT or a price to book or something, if those things don't look too crazy, then I will tend to continue looking, and I'll tend to probably just dive straight into the investor relations pages, go straight to that particular company's website and start reading actual reports. So those certainly aren't things that sort of have me arrive at a final decision on whether to invest in a company or not. It's really, those are kind of some initial criteria that I'll use to say, whether or not I should continue digging. And from that point, it's sort of going through the Philtown 4M checklist, meaning moat, management, margin of safety, trying to understand the business. Do they have some sort of competitive advantage? Is the management good? Can I predict what the cash flows are likely to be out into the future, and then come up with some sort of valuation and see whether I think the current price is attractive or not. Okay, next question is from Majesh. Hi Tom, this is Majesh from India, and I'm loving your videos for over a year now. Thank you very much. I'm interested in having a career in investing. My question is, please suggest some books for beginners if you can for basic fundamental investing like formula and stuff. I know you've suggested books, but I want to know about basic things like ratios and interpretation. Sure. So, I guess the place that I first started for that type of stuff, the first book on money I ever read was Rich Dad Poor Dad, which I know a lot of people have read, and I really liked it. Some people have mixed reviews of it, but I think it's really good for getting you in the right kind of frame of mind for making money and investing and so on. So if you're brand new to like money altogether, probably something like Rich Dad Poor Dad. From there, I would move to the Philtown books. I think if you know nothing at all about investing, you can still dive straight into those books. So probably Philtown Rule 1, or even if you just want to jump straight to Invested, which he wrote with his daughter Danny Town. That's kind of like a summary of all of Philtown's books up to that point, plus a little bit extra kind of in Invested. So that's probably where I would tend to recommend you go first. So appreciate your question. Next question is from Cam K. Question 1, has your investment criteria changed/evolved over the last 12 months? If so, what would be a couple of things you could share and what has caused the change? I had to give a boring answer to that question, but basically not much has changed over the past 12 months. I've certainly learned more about new industries and new types of businesses, just based on what I'm kind of looking into at the time. So, I've looked into Seritage Growth Properties, for example, not a stock tip, but looked into that. So kind of last year, so started learning a bit more about the commercial real estate industry and that sort of thing. But the overall framework of trying to buy something for less than it's worth really hasn't changed at all in the last 12 months. And question 2 from Cam, what types of businesses are you currently interested in? Not actual names, but what metrics are you focused on the most? Sure. So again, I hate to give a kind of boring answer here, but the underlying thing I'm always looking for in an investment is a discount to intrinsic value. And I am fairly open to different forms of that. So whether it's buying into a company that, you know, is in some sort of declining industry, but the business is just ridiculously cheap. Maybe they're trading at less than some sort of liquidation value. That's something I'm interested in. I'm interested in a stable business that, again, is trading at significantly less than those cash flows should be worth to, you know, a private owner of that company. And I'm willing to buy into higher growth businesses that, you know, I think I can have a reasonable, you know, estimate of the future growth for that company. And can, again, pay a reasonable price for it. So if I were to look at a single metric, you know, some of those businesses would look, say, really, really cheap on a PE basis, and some might look really expensive. But the PE ratio doesn't account for debt or cash or future growth or declines in that sort of particular company. So I try not to be too attached to one particular metric. I know I mentioned some initial screens with the snowflake example just earlier, but that's to kind of weed out extremes, you know. So I don't really have one particular metric other than price to intrinsic value, but that is certainly not something that shows up on anyone's financial statements. Next question is from Andrew H. How are you preparing yourself for the impending market correction / crash when fear overtakes greed? Sure. So, yeah, I don't know whether there's going to be a market crash or not. I guess historically speaking, they happen fairly frequently, so I'm sure I'll see at least a few in my investing lifetime, but I don't know when it's going to happen or anything like that. I try to avoid paying too much attention to macroeconomic stuff or market level valuation stuff. If I find, a selection of businesses that are at meaningful discounts to what I think they're worth, and I can understand those businesses well, and I'm quite confident on what the future of those companies look like, I will buy those regardless of overall market valuations. And some people will agree with that, some people will disagree with that. I think if you can buy, a business, for example, where you're going to get your money back in 2 years, they're going to pay out some huge special dividend, and, the business is doing quite well and they're in some super stable industry, then, really, even if the market goes enormously south, I'm still going to do okay in that type of investment. So I try not to pay too much attention to overall market valuation kind of factors. I guess the thing I do keep in mind is I sort of have a framework for, thresholds at which I will start to put more of my cash to work in the stock market. So, for example, if I think, I can find a few stocks that are likely to be doubles over the next 3 to 5 years, I'll put a quite meaningful amount of my portfolio into those particular investments. I then have another threshold for if I find some stocks that I think might be 3x's and then 4x's, and then the final threshold's like a 5x. That's kind of the last 5% of my cash that I'll put to work. So I guess naturally when market valuations are high, you tend to struggle a bit more to find companies that meet those thresholds. So you sort of naturally end up with more cash, for example, versus when markets are, tanking and things are cheaper, you sort of naturally tend to find more things that make sense. So although I don't have a view really on whether I think the markets are going to crash or go up a lot or whatever, you do sort of naturally tend to, hold more cash or less cash kind of as a byproduct of, I guess, overall market valuations and what I'm able to find at the time. Next question is from Investing with Frank. How do you calculate the growth rate of a business for your DCF? I've been working on this specifically for a while to be as accurate as possible. Curious to know what you take into consideration. Sure. So this is probably going to be quite business dependent, and I guess everything at the end of the day comes down to just understanding the business, understanding, the runway for growth. So if you're looking at, a McDonald's, for example, they have probably some runway for growth over a long period of time in terms of growing their, prices for their burgers and fries and whatever else, but they probably don't have a huge runway for growth anymore for adding additional stores. Whereas if you take a restaurant business that is earlier in their life cycle, maybe they do have a longer runway. So you're sort of trying to factor in those kind of qualitative factors. The other thing I tend to look at, I've used a couple of times something like Phil Town's Rule 1 Toolbox, and that will give you long-term growth histories for things like equity, free cash flow, earnings, and I think book value per share plus dividend yield or something like that. So that helps you sort of build a picture of long-term growth trajectories, and if you don't think that anything substantial has really changed for the runway of that business for growth or anything like that, then you can sort of extrapolate those sort of growth rates out over the next few years based off those numbers. But again, you've got to be confident that the business is going to be able to achieve those things and buy with a margin of safety and that sort of stuff. So I don't really calculate a growth rate as such. It's really like a bit of a qualitative, mix of art and science with looking at some historic growth rates, factoring in, tying that in with my understanding of where I think the business will go moving forward, and then trying to determine what I think is a conservative growth rate to apply to a discounted cash flow. Okay, next question is from Tom Mack. Hi Tom, hi from Tassie. I've written 2 questions. Feel free to specify from the 2 or answer both. Which sectors are you currently most excited about and why? Given that individual investors more often than not underperform the market, what do you think that you bring that will help you achieve above market returns? Sure. So on the sector one, again, I don't really have any specific sectors that I'm excited about, I suppose. Things I get excited about are when I find companies that are significantly undervalued for reasons that I can easily understand, and that sector can be all sorts of different stuff. So I don't really have a particularly exciting answer for you on that. I'll invest in high growth industries, low growth industries, anywhere that I think I can get a good return and I can understand is where I will tend to head. So I don't have too much to say on that one, really. But on your second question, given that individual investors more often than not underperform the market, what do I think I bring to help me achieve above market returns? So I think most people underperform the market because they don't have a good investing framework. I think a lot of people get attracted to the stock market in the first place because it's just going up, and we've seen a lot of that over the past 12 months, especially a lot of really new people getting into investing, which is great that people are trying to do that. But a lot of them are getting sucked in by seeing their dumb neighbor make a bunch of money on some speculative stock, and then if that stock goes down a little bit, they have no idea what they're doing. They get scared, they sell at ridiculous prices, they buy at overly exuberant prices, and that's really the reason, plus basically fees and a lot of activity and spending money on these frictional costs are basically the 2 things in my mind that cause most people to underperform the market. So I guess in terms of what I bring, it's just trying to have a rational, structured framework, and seeing, rising prices as increased risk, and seeing lower and lower prices, stock market crashes, as constantly reducing risk in terms of me making new investments to hold over the long term. So it's been rational and trying to make good decisions around that, I think, is really what helps to, build some sort of advantage in the stock market. There's a lot of really smart people out there, but one of the few edges, I think Seth Klarman said something like this, one of the few edges that you can still have as an investor is have a long-term value focus. Okay, next question is from B Swift. What 3 stocks would you hold forever and why? Yes, so I never give stock tips on this channel, so I'm not really going to give you a particularly direct answer to that. But judging by that question, I guess probably what you're looking for is something that you can just robotically continue to put money into. So again, not financial advice, but if you're in a position where you don't want to be looking at individual stocks and trying to analyze businesses and value businesses, your best bet is probably just to index. So, look at something like a New Zealand Top 50 or S&P 500 or ASX 200 or 300 or, whatever country or index you're in or might be interested in. That's probably a reasonable bet over the long term. Just reinvest your dividends, contribute to it consistently, and if historic market rates of return are anything to go by, you should come out the other side of it okay, after an extended period of time doing that. Question is from SC358. What are some of the resources you use for agricultural businesses such as farmland? What are some of the frameworks on calculating average earnings for land's production in aid to aid in calculating fair value, and what are some resources for local comps/appraisals? Sure. So I think SC is based in the States from memory. So all of the examples I'm going to be able to give you are going to be very New Zealand focused. But what I can tell you is that, and this will probably vary widely depending on where you are, but in New Zealand, for example, we have a couple of industry bodies that produce economic research every single year. So we have Dairy NZ, Dairy New Zealand, or Beef and Lamb New Zealand, which each publish an economic survey and will give profitability sort of stats on basically all sorts of different farm types by region, and whether you're an owner-operator or you're in some sort of shared ownership structure, or all sorts of different stuff. So in New Zealand, we have very good sort of economic research on that, and we also have fairly readily available comps, and you can see what a farm down the road sold for and all that sort of stuff. So that's one way to do it. The other way to do it, and this is going to vary a lot probably depending on the individual actually selling the farm, is that some farms will basically open up their financial statements and just let you see what they've literally done over the past few years. I don't know how common that really is, but I've certainly heard of it happening before, particularly on large corporate, huge scale farms where, the amount of money we're talking about is very, very substantial, and it's going to be, a multi-party transaction in order to acquire this massive bit of farmland. So it's going to be very specific to the area that you're in. If you're genuinely looking at buying some sort of farmland, there's agricultural professionals probably all over your part of the world that will be able to help you. But that's sort of what the environment looks like in New Zealand, at least. Okay, I'm just wary of how long this video is going for, so I'm going to pick out maybe 2 more questions to answer, and then we'll wrap this video up. So next question we have is from Angel. How do the mechanics of SPACs work when they trade above their intrinsic value prior to a merger? What happens after the merger? Yeah, so this is a really timely question, something that I'm sure a lot of people are pondering at the moment, and they should be if they're not and they're looking to invest in a SPAC. There's a lot of SPACs out there, special purpose acquisition companies. They're basically companies that are just an entity with a bunch of cash looking to acquire a private business as a way to sort of take it public. There's a lot of SPACs out there at the moment that are trading at substantially more than the amount of cash that they have in the business. This is not a company that earns money. It's literally just effectively like a bank account. And there's people paying, 30% more than what's in that bank account to acquire, some portion of ownership in that SPAC. And that does create some real challenges. So, if you were to, for example, just hypothetically to take all the money in that SPAC and then invest it purely in just an S&P 500 fund, you would have effectively just paid a premium for an S&P 500 over and above what you would have been able to just pay in the public market. So in that situation, it really doesn't make any sense to pay a premium for the cash that's sitting in that SPAC. Now, the thing that makes SPACs different is they often have access to businesses that you as a public market investor, small investor, have absolutely no chance of getting access to. It's unlikely that you're going to be able to go out and take Reddit public or some huge private company public. So that's really what people are paying a premium for. But what it does mean is that the promoter and sort of the person kind of heading up that SPAC has to get a really, really good deal in order for that to make sense. And with where prices are both in public markets and what I've heard of in private markets, it's really hard to buy things at discounts to intrinsic value, and effectively that's what the promoter is going to have to do in order to kind of counteract that premium that public market investors have put on that cash. So I'm sure some of these SPACs will work out very well. I'm sure some of them will work out very poorly. Which ones do well and which ones do poorly, I just don't know. So it's not a game that I've typically played in. But that's kind of the way that I think about it. Someone who is at the head of that SPAC and who's getting a big premium put on their SPAC in the market is going to have to make an extremely good deal in order to get over that extra sort of premium hurdle that people have put on that cash. Okay, and final question I'll take is from Karan. Go check out Karan on YouTube if you haven't already. Karan asked, do you have a favorite quote from any of the great investors? Sure. So there are a lot of really good quotes from a lot of good investors, and tough to pick a winner. So I'll give you a few that I like. I guess I really like from Charlie Munger, invert, always invert. That's kind of a mental model that really helps me challenge investment ideas and other sorts of ideas as well. Another Charlie Munger one is try to go to bed a little bit wiser than you were when you woke up. That's again something I've tried to apply as much as I possibly can. What else? Those are a couple of my favorite Charlie Munger ones. I also like a couple, this isn't really a quote from Monish Prabhai, but he's sort of talked about the concept of the difference between risk and uncertainty. That's sort of a mental model that I kind of like as well. Not really a quote, I suppose. Hopefully that gives you a few. Maybe another one from Warren Buffett would be something, and I'm going to probably butcher this, but it was something along the lines of, if you don't find a way to make money while you sleep, you'll work until you die, or something along those lines. So that's kind of, again, like a lot of these quotes that I really like are things that sort of influence the way that I approach general life investing and how I think about doing different projects that I'm kind of working on. So, that one from Warren Buffett, for example, is fairly inspirational when building something like a YouTube channel and trying to build some sort of additional income source that really, produces cash flow regardless of whether I upload a video or not. So, those are a few that I really like, but definitely let me know yours down in the comment section below. I'd be keen to hear that as well. So that's it for the Q&A. Thank you very much for all of your questions, and I apologize if I didn't get a chance to get to yours. Definitely keep an eye out for the next community post asking for questions, and feel free to put one in that next one, and I'll try to get to your question next time. But that's all from me today. I do hope you enjoyed the video. If you did, please hit like and hit subscribe, and I will see you in the next one. Cheers.